All right, man. Coming in at 5, 4, 3, 2, 1. Let's rock and roll. Welcome to the weekly update show. It's Conan and Jerry.
Jingle. I like that little jingle.
Yeah, this one just came with it. We'll get a better one.
Yeah, definitely.
Something groovier. How are you guys doing this week out there in Facebook land where this comes?
Facebook land, financial land.
How are you doing, Jerry?
I am doing great. Doing great.
I just rushed back from a lacrosse tournament, so I'm a little fuzzy, and it's not water in this glass.
Yeah, well, this show was brought to you by
Jameson.
Not Perrier, but Perrier in your Jameson is pretty tasty.
Yeah.
Pretty tasty.
All right, what do you got for us this week, Jerry?
Okay. So, weekly update, 9 August 2020. Oprah is may or may not be your favorite person, but I came across this quote, and it seemed to be pretty appropriate for this week. So, the reason I've been able to be so financially successful is my focus has never, ever for 1 minute been money, says Oprah. So,
it's easy to say when you got all of it.
Yes. Well, I totally agree. And a lot of people, right?
But she didn't always have all of it.
No, she didn't, right. So a lot of people, successful people, they always say, hey, I'm not in it for the money, I'm in it for, whatever the product that they're selling, they're helping people one way or another, right? That's the point. For me, kind of what I took away from this is what we want to do as technical sort of followers of technical analysis, it isn't to focus on the money. It's to focus on being on the right side of the chart. Okay, so it's a different take on this quote, but if you focus on the amount of money in your TSP account, right, you will either get greedy or you'll get afraid.
Yeah. No, I can remember the days long before meeting you where I looked at my TSP account balance, never looking at a chart.
Right, and most people do.
And that's not the way to grow the balance, right? That's not it.
Yeah, I mean, you like back in the day, there were guys on Wall Street that would read it was called the strip, and the paper would come off the little machine as the stock prices were going up and down, and they would read that and create it like a mental chart in their head, because you could tell the rhythm of the numbers, I guess, from the strip. And over time they've developed charts and stuff. So we don't have to worry about all that.
I think we got to get one of those machines in here just for fun.
Just for like nostalgia?
And spit out the paper. I'm going to be like, Jerry, tell me what the chart looks like.
Yeah. If you've never seen Wall Street, the movie, the first one.
In there.
Yeah, it's in there at the beginning. Yeah.
All right.
Okay. So what are we going to do this week? If you guys watched the show last week, we did an intraday chart of the C fund and the I fund. And both of those charts on an intraday basis led us to believe that the market was going to go higher this week. Lo and behold, that's what happened. So as we discussed last week, TSP stock funds did move higher this week. The CNS funds are both solidly above their 10-day moving average. I fund is still lagging a little bit. It's pretty much right at, but a little bit below its 10-day moving average. And it's still trying to get above resistance at 64. We'll take a look at all those charts. The technical indicators are still kind of flat, even though the prices have been going up on the CNS fund, which is kind of odd. You would expect the technical indicators to move higher. So we'll take a look at that. Before we look at the daily charts, though, we're going to take a look at two examples of a double top. We're going to look at the 1987 crash and the recovery from that, and then the 2018 correction and the recovery from that. Those are probably the 1987 crash was...
Doing a little history lesson today.
Yeah, a little bit. The 1987 crash, we lost about a third of the value of the S&P 500 in 1987 over the course of a month. So very similar to the amount that we lost in 2020. The way it recovered looks much different, but it's similar enough to make it worth looking at. And really, it's what happens when we get to the double top that I really want to kind of focus on. Basically, to manage expectations going forward. Then we'll look at the daily charts, and then we're going to talk about the F fund. Okay. All right. So we get the C fund 1985 to 1993. So this was the crash of 1987. Everybody talks about it being like a one-day super crash, and it kind of was, except as you can see on the chart, you didn't have to absorb the whole crash. We had a top here, came down, came back up. As soon as it dropped below that line, you should have gotten out, and you wouldn't have had to have absorbed that crash. But the vast majority of people ate that crash, and the difference between 340 and 220 is just about 1/3. So you lost about 1/3 of your money in that crash, which is pretty similar to the ratio that we had this year in February into March 2020. So the interesting thing about this one, it took longer. Like right now, we're going to show that chart next, but right now we're like this. Our recovery is really a V. It wasn't like that after the 2007 crash. Really what happened was the market was on a trend line, kind of like this. It crashed down and then just sort of continued on that trend line. That's not what we have going on right now, but that's what they did. That's what happened in 1987. So basically the trend line continued and it picked up and just kept on going. So because of that, it took, let's see, about 18 to 20 months or so to get back to the prior high, all right, which was up here. Once it got back up to that high, what happened? There was a whole bunch of churning in the market, right? We had another double top right here, and we had a correction. And then finally, right there, was the time to buy it because we knew we were out of that sort of sideways correction and we were going to go on to new highs, which we did, right? The 90s were awesome.
In more ways than one.
Yeah, the 90s.
Those were the good days.
Yeah, there were some days
we were in
right
our
there.
20s.
Yeah. Golly. Throwing me off track here, bro.
Sorry. That's my job. Supposed to add a little bit of levity.
I agree. Need some levity. All right. So here's the point. The reason I circled that part of the correction is because we are approaching the prior high, and everybody the focus is when we hit that prior high, what's going to happen? I mean, it's entirely possible that we come up, hit that prior high, and roll over, and we have a real long-term double top, and we go lower. It's also possible that we get just some kind of churning like we did in 1987, and then go higher. And that's really the best case. So hopefully that is what we get.
I mean, what kind of indicators are we looking for the best case and for the worst case? So if you're, obviously we're going to be following it, and if you're listening to us each week, we're going to kind of keep going back to this probably, right, and seeing if this is what's going to happen. But if you're outside of that, if you're watching the charts, what are you looking for?
You want to see a 5-step higher. If you get a 3-step higher, then you're expecting it to roll over. A corrective move goes in 3 legs. A primary move goes in 5 legs. So we're going to look at that on the next chart. But
now, you and I have talked about these 1, 3, 4, right, and 5 legs. I don't think we've talked about that on the show before. Okay. But maybe next show, because I know we've got a lot to talk about already. But let's kind of put that out there for folks so that they know what you're talking about. Some people may already know, but I think it's interesting because it again, based on all the things that we're doing here with the analysis of the charts, it does seem to hold true, like these little rules, right? So that's the point.
Right. It's not 100%, but and they sort of work in hindsight, but they definitely help. Yeah. So the reason that following the crash of 87, right? We have the crash, and then we have basically a 1 leg up to here. So call this 1, And then we have A, B, C, 2, right? Mm-hmm. And then we had a breakout. So now this is going to be 3 and 4 and 5, and it keeps on going. But if it had done 1, like 2, 3, like that, and rolled over, it would have basically a 1, 2, 3 is a correction. So the next leg from a correction is going in the other direction, which is the thing. But I'm gonna kind of count it out on the next chart.
Right.
So anyway, this sort of sideways consolidation is probably our best case going forward. Okay. So that
best case meaning that's what we're hoping for, or best case meaning that's what
we're hoping for.
Yeah. Right.
Yeah.
Not best because we don't know yet.
We definitely don't know yet. Yeah. No. So here's I want to talk about 2 things on this chart. So we just talked about 1987. Here's the 2018. We had a much more V-shaped V bottom, right? It's very symmetrical. We hit the double top here, right? So we got October 2018, and we got February, March, April, May 2019, double top. Then we had this correction right here. That's what we're looking for in the short term as we hit this double top here, right? We're looking for this correction right here. Okay, so going forward the next couple of months, that's the focus. Does that make sense?
Yeah.
All right.
To me, I hope everybody watching it does.
Yeah. Hopefully so. That's really the big thing to look at going forward. So we had our first recovery leg. We had a correction. If this correction had come down, came up and came down for 3, 4, 5, then we'd be down here below this low, and now, we're in a completely different pattern.
Totally different.
Yeah. We didn't get that, right? We had this correction. We came back up to new highs. We had a market churn, but that was good. Once we got back above this high right here, we're in pretty good shape. You should have expected the prices to move higher. So we had this sort of, sideways consolidation right here, and then prices moved higher. So now, okay, prices move higher. We have a top here in end of February 2020, and we have a complete collapse, obviously. So this is the thing I do want to do probably on the next show, but as a little, because I'm gonna make the charts a little bit different. But 1, then it comes back up to here 2, then it comes down to here 3. When I was looking at it real time, it came up to here. I called that 4, and I was waiting for this to come down to here for 5. Didn't happen. So what happened instead was we had 1, 2, 3. That means that was a correction. Mm-hmm. It wasn't a primary move, it was a corrective move. And the next move after a correction is a primary. So we get the bottom in March, and then we get 1, 2, 3, 4, 5. So right now, we haven't got to the top of the 5 yet because the price is still going up. Mm-hmm. But we are awfully close.
Right. And and would that new double top be those 2 tops of the V?
Yes.
Yeah, that's where the line.
Yeah. That's why when that's a pretty clear 5-wave, Elliott wave count. And it takes us right back up to a double top. So the reason I said the best case scenario in the 87 chart, again, we're going to talk about this next week, but just so you get the idea, this was 1, 2, 3, 4, 5. Then we want to see 1, 2, 3. It should take us down somewhere between 3,000 and 3050. Somewhere in there. If that happens, then we go higher.
Going up.
Yep. Now that's sort of a long-term don't worry about the time here.
That could be anywhere.
It could be years or
likely not years, months.
Yeah, well, this is a daily chart, so months. And obviously, it doesn't take into account anything other than technical analysis of the chart. Mm-hmm. We got a whole lot of things coming up in the next few months.
Really? What's coming up?
What's not coming up?
Right.
I mean, it's insanity what's going on. Yeah. So
there's some chaos coming. So, but we'll see, how that affects the market. It's one thing I've learned from you is to not worry about what else is going on and watch the market. Watch the charts.
Watch the charts.
Because the TV's not going to tell you.
No.
The TV is definitely not going to tell you. You got to watch the charts.
It's the only thing you can do. Okay. So that's double top. Double top for 1987. Double top here in 2015 or 2018 to 2019. And very likely double top here. And we'll see what happens after that. Hopefully, last thing, I'm sure you guys got the idea, but either the market rolls over, which is what happened here at the double top, or the market churns sideways, which in the big scheme of things is what happened here and also in 1987. So there's a lot of market risk at a double top. I just want to make sure I said that out loud because it kind of, in my mind, goes without saying. But the right. reason that I'm not in the stock funds right now is because there's a lot of risk at double tops.
Yep.
And the F fund has been going up consistently. So we're going to talk about the F fund at the end. But
yeah, and this goes back to, the philosophy of the way you do this is you manage risk the way you manage risk. I mean, your risk philosophy might be different than someone else's, and you can still use the same rule set and have a higher risk threshold. But, our philosophy is keep what you got.
Right. We had a great move in
July.
Don't
lose money.
Don't lose money. Rule number one, don't lose money.
Yeah.
And we can.
Rule number two is
you got to be in the stock funds when the market's going up. Yeah.
And out when it's going down.
Absolutely. Yep. He's learning. How about that?
I've been reading your weekly update.
All right. Okay. So let's do the daily charts. 9 months daily. We got, we have the collapse here. Like I pointed out in the last chart, this is 1, 2, 3, A, B, C, 4, and 5. But I'll put the question mark because we haven't quite got there yet. So RSI is looking pretty good. It's not quite as high as it was here at 3 on the last high. So we still have maybe a little bit of room to move higher. The weird thing, I think, is that the MACD is flat. This MACD is much more normal when the price is moving up. The fact that it's flat is just odd, and I'm not really sure what that means. It definitely means there's not a whole lot of momentum going higher. That's for sure.
And remind us again, the chart before this was 18 to 20 C fund. This one's just the 9-month daily. So this
correct.
Okay. So we're looking at the far right part of this, just zoomed in a little bit more.
Yes.
On that next chart. Okay.
Right. Exactly. Right.
I try to help those that kind of glaze off for a second.
Yeah. What do you mean? Who glazes off? People aren't like.
Well, they're thinking. They're thinking about what they're going to do.
It's good. It's good place to be. Okay. So yeah, that's the C fund. Like we said before, the big thing here is that we are very close to the double top, and we also have 5 legs up, so a lot of market risk. Okay. S fund, very similar, very, very similar chart. You got 1, 2, 3, 4, 5. We're not quite as close to the double top on the S fund, so we got a little bit of room to move higher. RSI isn't quite as high as it is on the C fund, and the MACD is still flat. So same basic idea as the C fund. I fund is a little bit different. If you remember last week, that was a big part of why I got out of the stock funds on the day that I did, was because the I fund was down 2.5% on that day. After the day after, it had already broken through the 10-day moving average. So, and you got the I fund is still in a downtrend on the indicators, both RSI and the MACD. So I fund isn't really looking that good. It's still trying to get above resistance. It's just at right above 64.
Can you zoom in right there? That kind of resistance mark, because I think that's easier to see the resistance. Yeah, when it's zoomed in, because otherwise it doesn't look like it.
Right.
At least to me.
Yeah, no. I mean, it's not exactly at 64, but
yeah, it's right there.
You can see it's having a hard. It's hit it several times. Tough to get past it.
Hitting the wall.
The wall. It's a ceiling, as we call it.
A ceiling.
Better to have a floor.
I usually run into the wall, not the ceiling. But.
Okay, so that's the I fund. Not looking as good as the C and the S fund. All right. That's it for the stock charts. And then the last thing I want to do is take a look at the F fund. So I had a lot of questions this week about why are we not in the stock funds? And I think we kind of answered that. Basically, I'm not in the stock funds because the risk, the market risk is really high in the stock funds right now. Yes, I'm leaving a little bit of money on the table because yes, as we said last weekend, we're expecting the market to go higher this week, and it did.
But it's in your risk threshold, it's not worth it.
It's not. You only get 2 moves a month.
Right. I mean, that's really what we always have to kind of come back to.
Yeah.
If we had as many moves as we want, this would be a null conversation.
Completely different thing.
Yeah.
Yeah. Yeah, and we might have that someday on a different product. So we'll tease that out a little bit, but
we're working on it.
We're working on it. Yeah. So the F fund. So if you're not in the stock funds, then you're either in the G fund or the F fund. Those are the only options. Fortunately, well, there's two pieces, right? The G fund, you can't lose money in the G fund, but you also don't have much of a, you're not gaining very much. In the F fund, you can lose money, but the F fund has been in a really good uptrend since it kind of recovered from the collapse in March. So actually, let me switch over to this real quick. You got, that's good. All right. You get the F fund that recovered all the way back up like immediately. I mean, that's quite a V, right? A lot more of an immediate recovery than the stock funds were. And then it kind of went sideways for a bit, but since June, it's been on a very steady kind of 30% up angle. I mean, you can't really beat that. It's very consistent, and if the option is between a very risky stock return and a very low risk but consistent, although less rate of return, but there is a decent rate of return and it's very low risk. With the number one rule being don't lose money, I'm in the F fund. Mm-hmm. It's just me. It's not everybody's risk tolerance.
Because it's nice and slow moving up, but it's also very low risk, and so you're gaining, you're not losing, and that's the key, right? Because and I'm sure most of our listeners get this, but there might be a few people that it slides past. So why the focus on not losing money? Well, compound interest is absolutely your friend, and this is a different way of looking at it than a lot of other analysts. A lot of people for years and years and years, it's easy to just say let it ride, right? You'll get it back because the stock market always goes back up. Right. Well, yeah, but you got half the account balance, and now compound interest is not working in your favor. Where if you'd have kept the money, maybe you didn't gain as much, but you kept that bucket full, you're going to have more money in the long run.
It's like a snowball.
Did I explain that right?
Yeah. No, absolutely. Yeah. I mean, there's a couple of different ways you can sort of
articulate it.
Articulate whatever. I mean, if everybody makes a snowman, right? So you get a snowball. When you start rolling the snowball, it takes a long time to grow, right? Mm. If you take off a third of the snow and then you start rolling it again, it's going to take you a while to get back to where you were, right?
Absolutely.
I mean, it's a.
We can make a cartoon of that.
Yeah, right. A little. I mean, you intuitively, I think people understand it, but the problem is the retail investment industry doesn't want you to look at charts and make a determination when something is risky.
Oh no, that's their game. They don't want you looking at charts.
They don't. They want you. They want to make this an algorithm that's based on a 6% annual rate of return, and it just doesn't. It's not that it doesn't work that way. It does work that way over a 100-year period.
Right.
And I don't know about you. I don't got 100 years.
Yeah.
Right. I need to make hay while the sun shines, as they say. And definitely don't want to lose money when things are going belly up. So, yeah. So anyway, that's why I'm in the F fund. Had a lot of questions about that, and that's why. So, quick little. What the heck just happened there? I gotta get out of this. Quick little tutorial about the F fund. The C fund corresponds on a percentage basis to the S&P 500, right? The same thing with the F fund. It corresponds to a thing called the Core U.S. Aggregate Bond Index. The AGG is the ticker symbol. So the F fund has a lot. We've talked about it. Has a lot less volatility than the stock funds, but you can lose money in the F fund. Okay, it's not the same as the G that can't have a negative quarter by statute.
Yeah, and that's just because they made the law, right? That's not because the G fund is that way. It's because they just made it illegal to lose money, right?
Yeah. It's not like illegal criminal. It's that's actually another conversation for another podcast. But the G fund is actually the best money market in the world.
Right, because you can't lose money.
That's just ridiculous. Number one. So yeah, that's great. But the thing is, and this will be like a little teaser again because we'll talk about it some other time. You basically get, so there's interest rates. There's like a 2-year, a 10-year, a 30-year. If you when you put money in a savings account right now, you get virtually nothing back for it, right? It's almost nothing. If you buy a 30-year bond, you're getting back whatever, 1.5%, something like that. Mm-hmm. Your checking account, you put money in your checking account, you're lending the money to the bank, right? But you're getting almost nothing for it. So the more time you give the bank to use your money, the better rate of return they're going to give you, okay? Mm-hmm. In TSP, we have access. We can move back and forth between the G fund every day, just like it's a savings account, right? But we get a rate of return as if it's a 10-year treasury note.
Yeah.
We get a huge, and no one else in the world gets that.
Yeah.
And the government is trying to take it away, just so you know.
Right. They're always trying to take it away. Yeah. That's why you got to pay attention to, the laws that come up, the bills that come up, and read, or at least not necessarily read them, but pay attention when somebody mentions something about this because it's important. And you just, that's when writing your congressman and saying, no, don't take that away.
Yeah, we'll do a little episode on the G fund. It's
a whole nother rabbit hole.
It's a big rabbit hole, and people are like, the G fund. You never want to be in it because you don't make any money there. That's true, right? Unless the market's going down.
If the market's going up, that's true.
If the market's going up, that's true. And the difference between making no money and making 1.5% or 2% in the G fund, if you're one of the TSP millionaires, is a lot of money.
Right.
So. And
that's what we want to make, more TSP millionaires.
More TSP millionaires. I'd like to get there someday. Actually.
We're helping people get there. We'll get you there.
Okay. We kind of went over a whole bunch of this, but a lot of people think that the F fund moves inversely to the stock fund. So you want to be in the F fund when the stocks are going down because the F fund moves inversely. That is not true. They don't really correlate. The F fund, when you buy the F fund, you're buying bonds, and bonds are debt. When you're buying the stock funds, you're buying equity, right? It's two completely different things. And what affects bonds is not the same thing that affects equities. So this is basically all right. So a bond, you're getting an IOU from the bank, and so if you lend them $1,000, and they're going to pay you back, 10% interest over 10 years, you're getting $100 a year on that bond. They're traded so that as the price of the bond goes down, the yield, what your rate of return is going to go up. So risk is different for bonds, and basically there's price and yield. So as price goes up, the yield, which is what your rate of return, goes down. So that's why when it gets a little bit confusing, but when you look at the price of the F fund, the price goes higher as the rate of return goes lower on the bond. So when it's confusing because the yield is the rate of return. And when the rate of return goes lower, it's because there's more demand for debt. And since the demand is increasing, what they give you back decreases. But that pushes the price higher. It's confusing.
That's why we have you here.
Well, it's confusing to me too.
Less confusing.
I get it. Less confusing, but I get the idea. So anyway, in the demand for safety, investors accept less risk on their investments, right, which is yield, and prices push higher. So the fundamental things that affect yield are basically the Fed, interest rates, inflation, the yield curve, which we kind of talked about, is the difference between the 30-year bond and the 10-year bond and a 2-year bond. If you graph that out, it's a curve over time, and the steepness of that curve means a whole lot of things in terms of interest rates and what happens in the bond market. So, not something I really want to get into right now, but the bottom line is the F fund is not affected by the same things that the stock market is affected by. And so just don't think that if I'm not in stocks, then I should be in bonds, because
it's not that simple.
It's not that simple.
Yeah, the C is going down doesn't mean the F is going up.
Right. And you can tell by looking at the charts, right?
Right,
I mean,
they don't match.
They don't match.
Yeah.
They're not the inverse of each other, so yeah. Yeah, so again, we're in this very consistent uptrend in the F fund, and we're past. Here was the prior.
Oh, you just jumped straight to questions.
How come the pen? Did it again.
Your fancy pen's not working.
Here we go.
There it is.
Here was the prior high in the F fund, and obviously we're already past it now.
Yep.
So the F fund is in good shape. And as long as interest rates continue lower,
which is highly likely.
Which is highly likely, with all the craziness going on in the world.
Yeah, the F fund should stay pretty stable.
Yeah, I mean, the more we need to pump money into the economy, the more the F fund, it's going to be stable. Yeah. I mean, interest rates need to go up for the F fund to go down, and there's absolutely no reason why interest rates would go up.
There's definitely no indicators that that's going to happen.
No. I mean, in the short term, you got the RSI kind of moving lower, but I seriously doubt it. I doubt if we get below the 10-day moving average anytime soon, it won't. I don't expect it to stay there. But again, if it does go lower, and the pattern of the stock funds makes sense, then we'll be back in the stock funds. I mean, we also have August, right? The seasonality, we talked about that a few weeks ago. August is a horrible month for stocks. And we're gonna almost 60 days out from the election. Everybody's trying to go back to school or not go back to school, whatever they're gonna do. It's insanity out there. So F and G fund are definitely your friends right now. And especially if you're trying to, enjoy the last part of the summer and you don't want to worry about the volatility.
Yeah.
So
are we enjoying the last part of our summer?
We need to go to the beach.
We definitely need to go soon. How about that day?
All right. That's it.
That's what we got for this week.
That's it, my friend.
All right. Well, thanks for joining us, everybody. If you have any questions, post them online. We'll do our best to answer them. Just a side note, if you do have questions, like specific questions about your situation, we're probably not going to be able to help you much. You want to touch on that real quick, Jerry? Just because we get a lot of, hey, I'm doing this, I got this going on. You really have to have like a personal financial advisor for that. That's outside of the scope of what we're trying to do.
Yes, if you need a personal financial planner or something, then you need that. If you want to talk about your TSP and how you use it in retirement if you're retired, or what you do, we do coaching calls. So if you're interested in doing a coaching call, email me and we can set it up. If you're a subscriber to the site, it's $50 an hour. If you're not a subscriber to the site, it's $100 an hour. and we talk about how all this is relative to your personal risk tolerance. So on that call, it's all about all of this relative to your personal risk tolerance.
Your situation.
Yeah, your situation. So.
Yeah, and of course, if hopefully everyone's aware that's watching this that we do have a subscription service.
Yep.
Jerry talked about it at the end of last show. It's a very good price point for the ability to validate your decisions on how to move your money when we move ours, and so it's a no-brainer to sign up. All right, let's call it a week.
That's it.
All right,
Sounds
we'll
good.
See you guys next week. And
a little ditty outro.
Boom. Got a little music. Forgot.
There we go.
We're jamming out here. All right, guys. Have a good week.
Cheers.